Since the Nigeria Tax Administration Act came to effect on January 1st, 2026, government officials and members of the private sector have continued to engage with key players to ensure its full implementation. The latest of such forum is organized by the Nigeria Revenue Service as government officials express commitment to driving more revenue for the government.
The new tax regime presents an opportunity for us to reposition our fiscal architecture in line with global best practices. However, the success of these reforms will depend largely on the strength of collaboration between the federal government and subnational entities.
The executive director of the Large Taxpayer and Government Directorate harps on the need for federal, state and local government agencies to work together to improve compliance under the new tax regime, noting that its monitoring and audits shows that while some states are meeting their obligations, others have structural leakages, especially in the prompt deduction and remittances of value added and withholding tax.
Let me state that some reforms fail because people assume enforcement is optional. But under the Nigeria Tax Administration Act, enforcement is built into the fiscal system. Section 80 empowers the Accountant General of the Federation to deduct all unremitted revenue due from any MDA or government from its budgetary allocation, and remit such deductions to the relevant tax authority.
Beyond enforcement for subnationals that default in revenue remittances, there will be rewards for states doing well.
Starting this year, 2026, the service will launch an initiative to identify the most tax-compliant states across multiple dimensions. And we look forward to honoring our top performers at the end of the year.
The forum brings together federal and state government officials to address bottlenecks in tax remittances in order to improve transparency ahead of the 2026 revenue push. Sarah Chimugu, Channels Television News.